Okay, so we've reached the end of our economic tour, and the last chapter is more of a summary, a summary of everything that you've seen so far. And just before we do finish, I want to kind of link into how it's often been tested, kind of bringing it all together. Although, of course, anything can be in the AM and anything can be in the PM, that's still the case. Economics, you look back over the past 10 years, there are lots to see in the morning. So what I would recommend is that, especially in the first chapter and little bits of the second one, things like the Taylor Rule, Grinald and Kroner, and the Singer and Terhar as well, and the business cycle, all that stuff, you will find lots of it in there too. But because it's a newer area too, then this point they're making here on the slide, very important to focus particularly on the institute. I say the end of chapter questions especially. Because it's a newer area, looking back at the past isn't going to help you. Perhaps take a tip from our economics here. Looking forward is going to help you a lot more. So the end of chapter questions in Schweizer, yes. The curriculum questions, yes. The online item sets from both Schweizer and the curriculum too. So most of this is a recap. And by way of a recap, just to remind ourselves of some of these ideas. When they talked about the drivers of trend growth, remember guys, we talked about things like labour inputs. And things like the growth. Yeah, the growth in the labour force. Demographic growth, perhaps also the migration bit coming in as well, and also the participation rate as well. So yeah, you had growth from the labour input side, and you also had the idea of labour productivity as well. And they used the term there, the idea of the desire. Yeah, the idea of the capital, I should say, coming in as well there. The idea of the capital deepening. If they invest the capital per person, you have better technology, better equipment, you're able to be more efficient in this way. Also, guys, in here as well, you had things as well like number 3, total factor productivity, technology, and how that's advancing as well too. So drivers of growth, have they changed? Think about the model that you use when we talk about integration and segmentation. What's the model? Well, we know it's the Singer and Terhar model. So the idea of looking at emerging markets developing and catching up, and the idea of growth rates and returns coming through as well. When you think about the funds invested around the world, the business cycles around the world as well, the reallocation perhaps geographically as well, where you want to be. Also, guys, the phase we're at, are we in that kind of boom phase? Are we in that more the downturn phase as well? Our positioning between equities and bonds, different sectors as well too. And when you think about, we talked about the current account and the imports versus exports, currencies, capital flowing in and out as well. A lot of that linking as well to that kind of confidence and boom, money coming in, money coming out of countries to economic growth or downturns too. Here in the UK, a good example of some of this has been, I mentioned a few times, our Brexit problems, I suppose. And the pound has certainly been affected. You think about the impact of all these uncertainties on our trading and everything else coming in as well too, of course. So moving on a bit further here. When you think about growth, which assets particularly are we thinking about benefiting in this way? Well, growth, that switch over to equities, especially from a kind of low point here, from that low point in the cycle, that switch to equities in this way. The growth results often in the higher interest rates. Inflation starts to take hold as well. Not good for our bonds. And this idea of regional reallocation they mention this term here, regional reallocation, between countries, between markets, picking out where you want to be, that country-specific version, thinking about where you want to be and being diversified, hopefully. So the idea about our Singer and Terhar as well, that the initially very high returns that are there reflect the high equity risk premiums. Remember, the equity risk premiums are fully segmented. As they become more integrated, then the equity risk premium is going to drop a little bit in that way. And the idea, guys, here, perhaps you should increase allocations more to emerging markets in this way, that you're getting the increased returns with hopefully less risk. This idea of the business cycle coming in, when you're at that trough of the business cycle, looked at quite a bit of this here. That's the time to start to invest in our equities, of course, guys, in this way, hoping for that low point all the way up in the steep curve in this way. Also, in this time here, you could earn some good credit risk premiums too as well, just before the recovery as well. So switching to some high yield might be earn some good credit risk premiums too as well too. However, the expectation of a rising economy, you want to avoid those rising interest rates and avoid bonds tend to underperform. The idea of how will the governments, how will they apply their monetary and fiscal changes, thinking about interest rates, of course thinking about taxation, thinking about trade, what will be the impact of all these issues, and of course also the wider policies here in Europe, thinking about what will happen with Europe and Brexit and the other aspects. How do you interpret what's going to happen here? And that's where, a big kind of, we don't know, but the idea of looking to try and forecast different scenarios here. Yeah, these changes in local regimes, whether it's taxation or central banks, we've talked about this, they're all particular goals, have a big impact. Guys, and finally that last part here, the idea of the exchange rates adjusting to, the capital flowing in and out, imports and exports in our current accounts, the idea of deficits, and that idea about what sort of term involved. Are these going to be long-term or short-term? What's the reason for this? Capital flowing in, will that be a longer-term thing? Remember the idea of overshooting. Initially, you get the FX increase, that idea of a smaller kind of reversion later on, that overshooting too. So let's take that account as well. Yeah, our capital flows, like we've talked about, flowing in where investment opportunities lie.